Hello and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
And I'm Katie Greifeld. I'm an anchor with Bloomberg Television and a cross-asset reporter.
And this week on the show, well, the Federal Reserve raised borrowing costs again this week, taking their benchmark interest rate to a 22-year high. And many on Wall Street believe the central bank is either finished or very close to being finished this very aggressive rate hike cycle. But what about the recession that so many were convinced would result from the central bank's aggressive fight against inflation? Was that just misplaced pessimism, or is the downturn still on its way? We'll get into it with our guest, who is an economist at a major investment firm. But first, I got a question for you.
Yeah, hit me.
And I know you went to college in the Philadelphia area at Haverford. I assume you sampled the cheesesteaks in Philadelphia at some point in your collegiate career.
No, I've never had a cheesesteak. I feel like I'm immediately killing our banter, our top of the show banter, but I've never had a cheesesteak.
You've never had a cheesesteak? Oh
no, it just, something about the strips of meat never appealed to me. I do eat. I'm not a vegetarian, but just did not float my boat.
Oh, man. All right. That's fair. So your answer is none of the above. NA. Not applicable.
If I had said yes, what would have happened?
My tradition here is to ask Philadelphia area guests what their favorite cheesesteak joint is. And I'm going to tell you right now, Katie, if our guest this week actually is a cheesesteak eater, I think I can guess what his favorite place is. And this after never having met him, never spoken to him. That's how good I am. All right. You ready?
All right. Well, I'm excited now.
Let's bring him in. He is Joe Davis. He's the global chief economist and head of the investment strategy group at Vanguard. Joe, welcome to the show.
Thanks for having me.
All right, Joe, you ready to be blown away?
Yeah, let's go.
Your favorite cheesesteak joint is Larry's Steaks on 54th, I believe it is, and City Line on Hawk Hill. Am I right?
Not bad. Not bad.
Did I get it?
It's not my favorite. So I grew up outside of Philly, but I went to college in Philadelphia proper. So Larry's is a great one, particularly after midnight, because being in college, it's a good cheesesteak.
Joe is, I believe you might be our first Hawk, our first St. Joseph's University Hawk on the show, which is exciting for me. I have one of 6 kids. Everyone in the family went to St. Joe's but me. Yeah, it's crazy.
Well, how is this? So if you're from Philadelphia, you know a rivalry of St. Joe's is Villanova, right?
Oh, absolutely, yeah.
So that's where my daughter's going next year. So we're gonna have some family tension.
Oh yeah, boy, you're gonna let her back in the house?
I don't know. My son's at Penn, so we have almost the entire Big Five. So yeah, long live Philly.
3/5 of the Big Five. Well, Joe, let's get down to business then. We had the Fed statement and press conference today. The vibe I'm getting is not too many surprises. We got the quarter point rate increase. So the Fed funds target's now 5.25% to 5.5%. Anything shock you today or surprise you at all about the statement or what Jerome Powell had to say?
No, I mean, nothing's really surprised me, Mike. I mean, again, I think the big open-ended question is the same question that we were facing at the beginning of the year. And that really is how much work, if at all, there needs to be done from the Fed, which really brings to the heart the essential question, which is how restrictive are they today? You heard Chairman Powell saying they're restrictive by any measure. The question is how much, because if you can get a handle on that, then you know how much both inflation will fall and how much economic, damage may be done over the next 6 to 12 months. So that I think that's still the open question that we were facing at the beginning of the year.
Something else that I wanted to ask about, though, was the fact that just stepping back from, will they, won't they, in terms of rate rises, it's been striking to me how there's been so relatively few dissents on Chairman Powell's watch. This was another meeting that was completely unanimous, even though in their words, in the Fed speak that follows every big decision, there seems to be some disagreement. You never see that in the actual votes. I'm wondering if that's something you've noticed as well.
That is a good point, Katie. I have noticed it. I think that if, going forward, we may see greater disagreement. Certainly, there's probably more healthy disagreement in the actual discussions when they're making the decision rather than the statement. But I think Chairman's been able to navigate that with more of the first the pause, the last meeting, and now being a more data dependent phrase, because you do have, a healthy spectrum of those wanting to go a little bit further and those thinking on the Fed that they've done enough. So I think that's also somewhat of a testament to his leadership, being able to navigate that. But I think from here on out, I think the probability of having, some modest dissent could rise.
Do you think at all that it sort of muddles the message coming from the Fed that there has been unanimous votes up until this point? And the reason I ask is because I was listening to Andrew Hollenhorst from Citi on ETV immediately after the decision, before the presser, after the decision, saying that basically they sacrifice clarity in having a completely unanimous vote, especially after what we saw in June, where they decided to skip, but they signaled more raises to come. Is that something that irks you at all? Something that muddles their message, or are they pretty loud and clear here?
No, I mean, I think they're closer to loud and clear. I mean, I think the reason why we probably haven't seen as much of a dissent or open-aired sort of dialogue is because inflation is still well above target. Yes, it has come down. The more recent data is lower than what it was a year ago. But I think that they're still off on their core mandate, which is why we're seeing still coalescing around the final decision. I think, again, as we get closer to 2%, could be a ways off, but as closer we get to 2% inflation, I think you could see a more healthy debate, including on the voting.
Joe, I think one of the remarks that caught some people by surprise was when Jerome Powell said he doesn't see the economy getting back to that 2% target until 2025. So, another year and change, 5 quarters or so. Does that make sense? We've seen such an aggressive drop from, what was the peak in headline CPI, like 9 to 3 in the last print. Does it make sense that it would take that much longer to get to 2? Is it a story of base effects that, now we're comparing year over year to inflation that had already cooled off? How are you thinking about how long it'll take to get to that 2%?
Well, I think it will take some time. I think that's, I think that was a subtle but a very important point. Actually, it's one of the most important comments I thought that was made today, Mike. And that, there's our own research and projections, the Federal Reserve's projections, as well as academic analysis, including from former Chairman Ben Bernanke, all point to the same outcome, which is inflation remaining elevated, meaning above 2%. For some time. The primary reason for that is the tightness in the labor market. And so, I think that's where, and we have been of the view, have had strong conviction for some time that we were going to need to see some material cooling in the labor market to get to 2% in any near-term horizon, because it is in the wage dynamics. And so I think the bond market has slowly come to grips with that, starting to price out cuts. Right? If you recall at the beginning of the year, there was high conviction in the bond market. There would be significant easing almost at this point right now. And so I think even those comments today, I still think point to the fact that, it's going to take some labor market weakness to get to that last yard, as many call it, from 3% trend inflation down to 2%, which brings up another, I think, important debate that words matter with respect to this narrative around the soft landing, but perhaps I'll save that for another question.
Before we get there, and I do want to get there, I want to talk a little bit more about what you're saying about wages and the fact that we need to see some cooling in the labor market to get back to target. Is that because there's evidence of a wage price spiral at this point?
Well, I think there was clearly that last year. You had wage pressures that were significant. 6-7%. You had labor market turnover that was as high as a generation. Now, again, we all knew some of that was somewhat temporary, but I think where I come out, there's not a wage price spiral, but the fact is the labor market is imbalanced, and we've grown. Those measures that many point to, the vacancy to unemployment rate. That ratio, one is in balance, number of vacancies equal number of unemployed Americans. We've grown that data actually back to as far back as World War I, so 100 years, which gave us early insight during the throes of COVID that we're going to have some wage-based inflation pressures. That ratio now has come down. That's good news. But we're starting to enter the territory. The ratio is right now 1.5 vacancies to unemployment of 1. So 1.5 is above 1. It's imbalanced. Demand exceeds supply. We're starting to enter the territory where any further drop in vacancies starts to be associated with a modest increase in unemployment. That's important because that suggests that, and there hasn't been an exception to that for 100 years. So if we're right, we should see some further weakness in the labor market. If we do not, then that opens up a different door, which means inflation may be stickier than we think. And that would be a surprise to the market.
I did want to wrap in this conversation we're having on the labor market to current events that we're seeing in the economy, especially when we're seeing all these labor negotiations. We saw a big win for labor unions this week with the Teamsters versus UPS. And actually, the Teamsters chief was on Bloomberg television after that saying that now they're taking the name at Amazon. And I'm wondering how you're viewing that, whether those are one-off scenarios where, maybe that segment that was involved, that union that was involved gets a price hike, how that is fitting into your overall view on the labor market right now.
Well, I think, if you talk to friends and colleagues, as even a boss and as an employer, you can feel the tightness in the labor market when you're looking for applicants. It's in the data. It's in common experience. Is not as tight as a year ago. Last year seemed like really a frenzy where demand just was drastically exceeding supply. Labor turnover has come down. We know wage increases are double the rate when you leave a company for a new job than when you stay at the existing one. So as labor turnover has come down, the wage growth has cooled. And again, this is good news for consumers, but the fact is we still have an imbalanced labor market. Now, that's why the biggest reason why the Fed took rates from 0 to 5%, right? It's just that there was that debate a year ago, you remember, between Waller and Summers and others, and some calling that immaculate disinflation, meaning you could have that ratio, which at one point was 2 vacancies to 1 unemployed. You could fall almost magically to 1. I'm just saying that's historically unprecedented. You can drop from 2 to about 1.5, maybe 1.3, which we're tracking along that pace. At that point, it becomes that line becomes a little kinked. And so any further drop in vacancies to get a better balance in the labor market, which gets to the wage pressures being a little bit less, intense, you start to see a rise in unemployment. And so there's no getting around that trade-off at some point. And that I think the soft landing crowd has to come to grips with is it theoretically possible? Sure, but it would actually require decent good luck and further labor supply coming out of the woodwork for us to magically balance the labor market over the next 6 months.
Well, Joe, let's talk about that soft landing notion. I mean, it seems like it's getting a bigger and bigger sort of constituency among economists. One of the interesting things Powell said today was that the Fed staff is no longer forecasting a recession. The IMF this week raised its growth forecast for next year. And at Bloomberg, obviously we do a lot of surveys of economists. They've boosted their GDP estimates for the second and third quarters. According to that survey, consensus is there's about a 60% chance of a recession within the next 12 months. I'm curious how you're handicapping it. Is that 60% sound high to you, low to you? Is it more of a sure thing than that? How are you thinking about?
So I'll give you my answer. I'll also give you it's semantics, but it's actually a very important one. And that is actually many of the forecasts out there, although they seem dramatically bipolar, either there's a recession camp or there's a soft landing camp, right? Mm-hmm. The forecasts, including the Fed, including Vanguard's, our forecasts, and many from many economist firms, they're actually more similar than different. There's been this bipolar sort of, we're in the recession camp or not. Why I say that is almost everyone has a rise in the unemployment rate of at least 30 or 40 basis points. So going above 4% over the next year, right? Right. Well, historically, that has been 100% associated with a recession. Now, not necessarily deep in magnitude, but a recession. That, by the way, is the Federal Reserve's forecast.
Right.
So the Federal Reserve, semantically, they're on record saying no recession. But by that metric, it would it is a recession because you have very modest job losses. Now, GDP could be, 0.5%, 1% next year. That's closer to our projections, 1%. Here's the quiz. In 2001, which has been our central tendency of what's the most closest reference point for a very mild recession, which is our baseline, 2001, GDP never fell on an annual basis.
Really?
Yeah, we had unemployment rise. Yeah, no. In fact, many recessions do not have GDP fall in the calendar year which they occur. Again, except GFC and 1982 and all those deep ones clearly fall. So again, we haven't changed our view on that. The data has been a little bit stronger than expected, but ultimately our view has been you can't have your cake and eat it too, which means to get inflation down to that last yard at 2%, you have to see a modest weakening in the labor market, which means the unemployment rate's going to rise, although hopefully not drastically. Let's say 4.5% over the next year. Well, that's a 100 basis point rise.
All right.
So by definition, that is a recession. Now, anyone who thinks that that's a soft landing is spitting in the face of 150 years of history. I'm just saying that that's categorically wrong. Now, I think what the soft landing camp really is there's actually no landing at all, meaning there's no rise in unemployment. Now, I would assign the probability of that of roughly 15%. I mean, that would be both good luck on the supply side. We still have an increase in labor force participation rate, for example, right? We got better news there. And you would have the Federal Reserve really calibrating it just the right way, the 5.5% Fed funds with core coming down. It's enough to have non-farm payrolls over the next year come in, I don't know, let's say 100,000. Just enough to have a rise in unemployment rate, but you don't have job losses where you start to really, start to see sentiment weaken further. Effectively, that's an environment where businesses do not really have job cuts. They just pause on hiring. That is in my mind is what the soft landing really is. And so that's where I think, from an economist perspective, that may sound a little bit like, splitting hairs, but it's actually important. So our view, we say that is a low probability. So the odds of recession are higher than 60%, but we're not calling, like for a deep recession. It's fairly mild and closest example is 2001. So hopefully that's helpful. I just see this disconnect between those saying we're going to avoid recession, yet they have an unemployment rate rising of 100 basis points. I just don't think that's possible to have those two outcomes at the same time.
Joe, there's a lot to dig into there, but I want to return to a point you made that to get to the last yard, to get back to 2%, sort of the plain question I have is whether or not that's worth it. Is it worth it to get to 2% and tip the economy into a recession versus accepting, maybe a higher inflation rate of 2.5%?
Again, it's a fair question, Katie. I've heard that dialogue. I've been in research meetings with Federal Reserve officials. That conversation has been had. I hear that argument. I just think it's risky. Could it work? Yes. I mean, why die on the hill for 2.7% core inflation, right? The only risk to that is what happened in 1967. And that's actually the one year where the yield curve inverted, yet we didn't have a recession. People call it a soft landing, but as I've written to our own clients in Vanguard, what happened 2 years later was actually a deeper recession and inflation came back. Now, that's not our baseline, but why I bring up 1967 comes back to that indicator I mentioned before, the vacancies to unemployment ratio. In 1967, conditions were very similar as now. The Federal Reserve cut rates because of a little bit of credit pressures in the banking sector. Now, again, the Federal Reserve is not cutting rates today. Within a year, though, that vacancy unemployment ratio, it had cooled down, but it always remained well above 1. It started to rise again, closer back to 2, which is where we were at the beginning of the year. And so the Federal Reserve had to switch course dramatically and actually had to take rates. They were at 5.5. They took them down to 3. By the end of 69, they're up to 9%, and a deep recession followed. Why? So, you could let inflation kind of hover at 2.5, 2.7. I would be looking at that point, if that was the decision, where's that vacancy to unemployment ratio? Is it good? Is it around 1, which is like the true soft landing? Or is it going back up closer to the 2 ratio that we had at the beginning of the year? If that is the case, then I would be screaming for higher rates because we have seen that play out before. So I would put a caveat, like if you're going to pursue that policy and let inflation hover around 3%, really keep a close eye on the imbalance or balance in the labor market, because that was a mistake that I think many would take back, that mistake in 1967.
Hey, Joe, if I could ask you to switch hats for a minute here. As I said at the top, you are the global chief economist at Vanguard, but you're also head of the investment strategy group and on the portfolio management team in fixed income. So I'm curious how you're thinking about the bond market. You know, it seems like yields have sort of settled into this range last few months, call it 4.8, 4.9 on the 2-year and about 3.8, 3.9 on the 10-year. We did have the 10-year spike above 4 a few weeks ago, but it seems like it's settled back into that 3.8, 3.9. You know, at least on a nominal basis. Obviously, real yields are another story. They're rising as inflation comes down. But are we just kind of locked into this range for nominal yields, do you think, if the Fed is sort of going to plateau rates for the rest of this year and next year?
I think so. I mean, I think, first of all, from an investment perspective, our theme has been for a year that, bonds would come back because you have some rich real yields that you mentioned, Mike, right? You have real yields positive across most of the term structure. It's something that, that I've called at the beginning of the year, the return to sound money, right? And I think it's been the best positive single development in the financial markets in the last 20 years, bar none, because we have less of a subsidization by savers to those who've had debt, because you had negative real interest rates. So That is a theme for us. I think within the fixed income market, to have a higher long end of the curve, to have a higher 10-year treasury, you're going to need to make an argument that either inflation is going to cyclically come back, which I would say more as a tail risk, although certainly possible. The other one is that R star, the so-called neutral rate, is higher. And as our listeners may know, Vanguard, we've published research, we've put it on external websites to say that R star is higher, which is one of our theses going into the year, that the Fed wasn't as restrictive as people think. So I think from a fixed income perspective, again, bonds are back. They're providing income across various investment strategies on the corporate sector. I mean, you see the total nominal yields, and on a real yield perspective, they're pretty compelling. On the municipal space, similar case. So I think it's been a great development. We viewed this as really as a positive outcome for investors. My biggest concern 5 years ago, Mike, is that we had negative interest rates. Remember the concerns around secular stagnation, and low interest rates forever. I think this is the power of compounding from an investment perspective is pretty powerful.
So just to draw that point out a little bit, maybe this is an oversimplification, but if R star is higher, do treasury yields across the curve need to be structurally higher as well? Yes,
it's an esoteric term, Katie, as you know, but it's effectively a way of saying what is the neutral cash rate, right? Which is the base asset for any security in the world, equities, fixed income, private equity. So the risk-free rate, what's that neutral risk-free rate? No one can see it. It's like something in the heavenly bodies. You know it's out there, but you can't actually feel it with your hands. But our research that we've updated, actually it's Federal Reserve's own research, we can show that it's 100 basis points higher than whatever that neutral rate was before COVID. And it was starting to rise actually before COVID. And it doesn't move on a dime. So if we're right, that means the neutral nominal rate is roughly 3.5%, maybe perhaps as high as 4%, say a cash rate, a treasury T-bill. And then you would price out the yield curve from that, which would get at a fair value potentially for the 10-year treasury over time. So with a modest steepness in the yield curve, you can get a fair value 5 or 10 years from now on a 10-year that's a little bit higher than where we are today. And that's really the debate in the market. The market bond market, as you know, was very skeptical that we were ever going to leave that secular stagnation camp. We were anticipating high odds that we would. We just did not know the timing of it. But we think there's more permanence to the recent rise in interest rates. Yeah, the Federal Reserve may cut rates in the next 2 years with some economic weakness. But I think neutral rate is clearly, nominal rate is clearly in the 3%, 3 to 4% range. We can debate within that range and if it's slightly over that. But again, that's a dramatic shift from where we were pre-COVID.
And Joe, you'll have to forgive me, but I'm a journalist, I think, in headlines. So
Unforgivable.
listening to what you're saying, I mean, 10-year yields right now, we're at 3.86%. If the cash rate is, 3.5, I have to assume that has to rise. Is this the end of the bond bull market then?
I would characterize it differently. So my headline would be, there's more permanence to this. And this is really good news. So I think those that have been betting that we're well above normal ranges and betting on a significant drop in interest rates, I just think it's off base. Now, this fair value range, the 10-year treasury is 3.8, but there's a probability of recession in the next 12 months. And so the market's trying to assign a certain probability to that over the next several years, which can drop us below what the numbers I just gave you, right? So It doesn't surprise me that we're a little bit below the 4.5% range on the 10-year, because it's also trying to discount economic weakness in the next 2 years. But I think we're within a normal range. I think the big headline I would be putting is bonds will stay back. The headline beginning of the years was bonds are back. I think that they'll stay high in their perch for the foreseeable future.
Chairman Powell duly noted at the press conference the long and variable lags of monetary policy and how signaled they're still kind of waiting for perhaps some other shoes to drop. We saw the issues with regional banks in the spring. These days, there's this sort of slow trickle of alarming news in the commercial real estate sector. There's a lot of debt coming up for refinance in the next few years at much higher rates, with much lower occupancy rates on top of it. I'm just curious how you're thinking about that long and variable lag and where maybe we should be looking for the effects to perhaps surprise people. I mean, is it commercial real estate? Is the regional banking issue not something that's completely solved at the moment? Where perhaps would you worry about effects from this aggressive interest rate hike campaign that we haven't really seen yet?
Yeah, well, I think it'd be two, Mike. I mean, clearly commercial real estate's gotten the most attention, and not to say that that's misplaced. Myself and my team are looking at two other areas in addition. And one is, if we're going to have a recession at all, or let's call it, just a significant slowdown, we had it in housing, but there has to be weakness in the construction, in the employment side. Our analysis would suggest that the pent-up demand, which is still significant from the COVID type period, that starts to wean its way through the system by November. And so after that point, if there's not renewed demand, then we're going to start to see modest layoffs. That's the break even. So it puts you into early 2024. And then the other one is what you said in terms of terms out, in terms of refinancing or new debt costs. Again, because a lot of the locking in of low interest rates during COVID, I think there is some truth to the fact that the lags could be somewhat longer this cycle because of the lockup. Effectively, the interest rate sensitivity for the economy right now is lower than what it would be on average, right? And so both of them put you into, not that interest rates don't have an impact on the economy, it just puts you in the downturn, the slowdown being later into 2024. That would corroborate with another piece of evidence, which had nothing to do with the lags, and that's just what the fact is. Only now have we had the real Fed funds rate, so where the Fed is 5.5% today, minus the rate of trend inflation, which has only recently gone. That those lines have only recently crossed, and so we've really never had a recession without the Fed funds rate being at least 2 percentage points above the rate of core inflation. So if you put core at 4.5 roughly, let's say in 3 months we're down to 3.5. Only then do you start really ticking the clock between those long and variable lags impacting the economy from a growth perspective. So housing is still, I think, something I would focus on. It's tough for me to square having a slowdown in the labor market and not having some modest job losses on the construction side.
Yeah, and it's been really interesting to watch the home builder stocks in particular really crush it this year because people just don't want to sell out of that 3% mortgage. The supply of existing homes has been very tight. So definitely an area that we've been watching at Bloomberg. But I do want to ask about, we're talking about all these scary things. And I want to talk about what is the haven asset in this environment, because you would think it's treasuries, but then you take a look at Treasury volatility, it's come in a little bit, but it's still pretty elevated relative to history. And then you take a look at some of the big tech stocks that are just absolutely crushing it this year. And it feels like there's no volatility to speak of. And I haven't even mentioned the VIX here. And Joe, I guess this is a long way of asking, why is it that tech stocks have pretty much supplanted treasuries as the safety trade this year? And do you think that, maybe that holds water, that maybe that's not the worst dynamic in the world?
Well, we looked at that, Kate, it's a good question, even over a year ago. And we're back to where we were a year ago, right? Where we had growth stocks at just, fantastic valuation levels, at least relative to, say, the other half of the universe, more value-based companies. And I think there's two things going on. One is legitimate and one's more of a narrative, which you start to get concerned with overvaluations. The narrative is today it's AI, but before it was platform effects, network effects, winner-take-all dynamics. Again, there's some truth to it, but it's one of the reasons why you can get overvaluations. It's the extent of the multiple that's priced in. And the other one is just a discount rate. I mean, I still think, you can justify some of the growth stock, the tech stocks valuations only if you think that we live in the old world and that rates are well above where they should be, and that we're going to ultimately go back to the very low interest rate environment. So I don't think, tech stocks are certainly not immune to gravity. So if you ask your question, like where's there a haven, I would want to stay fully invested. I mean, I think the natural response would be cash, but over a long period of time, I'm not going to get really a strong risk premium for that. So, for me personally, I'm looking at areas that haven't been as loved for the past year, and that's like the value part of the market. You're still participating in the equity market, but it doesn't have that major run up like you have on the tech side. And I don't need value stocks to grow at the same pace as growth stocks to win, because that has not been the case historically. So I would put the value risk premium. It's been a headwind the past 6 months, but I think over long periods of history, it's been a tailwind. So that's where I'd be kind of rebalancing into, because the market is pretty unbalanced within the equity market.
Well, you're listening to Joe Davis. He's the global chief economist and head of investment strategy group at Vanguard. Katie, at Larry's Steaks in West Philly, the name of the sandwich, the famous sandwich, is the belly filler. You're just disgusted. I was gonna say, yeah. I think Joe filled our belly there with a lot of good information there. Is that too weird? The belly filler. That is foul. Joe, the belly filler.
I hate that.
Oh, thanks, man.
The belly filler. I always love that one. Anyway, Joe, we can't let you go just yet. We do have a tradition on the podcast where we have to reveal the craziest things we've seen in markets. Or in your case, I'll take in economic data, whatever you got for the week. Katie, how about you go first?
I think this is pretty good. Take a look at the Dow Jones Industrial Average. On Wednesday, it closed its 13 straight up day in a row, a win streak of 13 days. That is the longest win streak for the Dow since January 1987.
Since 87? Oh, boy. Well, that's an ominous year to bring up. I don't know about that connection to 1987. I guess we got 10 months till everything hits the fan. That is pretty amazing.
Yeah, enjoy it.
13 days.
Yeah.
Wow. That's a good one. That is crazy.
Yeah.
You did well.
Thank you. All right.
How about you, Joe? You got anything crazy for us?
Yeah, I would say one that probably matches Katie's chart, and that would be, the number of web searches for the phrase soft landing. It used to be high, then it dropped to 0. Now it's back at record highs. And so I think those two charts would be very highly correlated. Maybe they stick for the rest of the year. I'm skeptical, but hey, here's the wishing.
All right. Good stuff to both of you. I'll give you mine now. All right. This is courtesy of CBSnews.com. Joe, I prefer the alternative asset classes for my crazy things. And this is about as alternative as it gets. It's a gold, ruby, and diamond ring worn by rap legend Tupac Shakur during his last public appearance.
Wow.
How about that? And it's pretty cool looking. It's got a crown on it, and the crown is made of rubies and diamonds and gold. He apparently was a big reader of Machiavelli and liked the medieval kings and medieval lore of Europe. Anyway.
No kidding.
Yeah. Who knew about Tupac? went up for auction at Sotheby's. So it's time to play that game. The price is precise. I regret to inform both of you. You are contestants. Katie, what's your price on the winning bid for rap legend Tupac Shakur's gold, ruby, and diamond ring?
Can I tell you something horrible? I actually just Googled it because it sounded very pretty and I wanted to see what it was.
No Googling.
I'm sorry. I removed myself from this contest.
You forfeit. Well, Joe, I got to tell you, you're automatically the winner, but I still want to hear what your bid is.
Oh, I don't know. I heard that I was just going to throw out $1 million. I have no idea.
Are you Googling too, Joe? You hit it exactly on the nose. That's impressive.
How big was the diamonds and rubies?
Katie, does it say? I don't know, but
It's not, yeah. I mean, the diamonds are accents. I'm on people.com right now. It's more about the crown is really the centerpiece of it, and the crown is gold.
Yeah.
Well, that makes more sense to me though than things like sneakers and stuff. At least there's an intrinsic value. Who knows? Well, at least if you're gonna diversify in alternative assets, you got that. You got gold, diamonds, and rubies. So you got multiple.
You got it all covered,
right?
Sotheby's had only estimated 200 to 300,000, so way off base. They said This makes it the most valuable hip hop artifact ever sold. I don't know. Artifact sounds.
Well, you could tell that the Federal Reserve that perhaps financial conditions are not that restrictive when you have things like this going on.
We're going to add Tupac's jewelry to the financial conditions index. And rest in peace to Mr. Shakur. My old college buddy Jeff Perlman is actually writing a biography of him. So, a little shout out to him. Yeah. Joe, a pleasure to hear your thoughts. We really appreciate it. Oh, and you never did give us your favorite cheesesteak joint. It's not Larry's.
Oh, I'd go Pat's downtown.
Yeah? All right. Yeah.
But they're all good,
Classic.
And, Katie, you should try the chicken cheesesteak. It's a nice diversifier, too.
I'm gonna buy you one next time I'm in the office together, Katie.
I appreciate that, but I'll just have a burger.
Man. Oh, man. Anyway, Joe Davis, thanks so much for your time. We really appreciate it.
Thank you both for having me.
What Goes Up will be back next week. Until then, you can find us on the Bloomberg Terminal, website, and app, or wherever you get your podcasts. We'd love it if you took the time to rate and review the show so more listeners can find us. You can find us on Twitter. Follow me @Vildana Heinrich. Mike Regan is @Reganonymous. You can also follow Bloomberg Podcasts @Podcasts. What Goes Up is produced by Stacey Wong, and our head of podcasts is Sage Bauman. Thanks for listening, and we'll see you next week.